You've heard the buzz, right? A self-managed super fund is pitched as the ultimate way to get your hands on your retirement funds early, to take back control from the big industry super funds, and maybe, just maybe, buy that investment property with your super. You're keen, you're ready to go, and you want to get started. But just hang on a second. What if I told you that for a number of Australians, jumping into an SMSF is the single biggest financial mistake that you will ever make? What if that dream of control quickly spirals into a nightmare of crippling penalties, compliance issues, and catastrophic losses? G'day, and welcome to the SMSF Property Guy, your channel for straight up, no nonsense advice about using your super to invest in property. My name's Jason McCall, and today we're covering something absolutely critical: the unfiltered truth about what it takes to run your own super fund. Before we get into it, if you like what you see, please share, like, and subscribe to our channel to get all the up-to-date SMSF news and information in Australia. Now, let's get back into it. Before you sign a single page or move a single dollar, there are some essential warnings you need to hear that could save you from torching your own financial future. And please make sure you stick around for our bonus at the end of this video, because I'll be sharing a quick look at my SMSF blueprint and industry comparison chart, which are the first two tools I give my clients to help them navigate the SMSF space. Let's be honest about why you're even watching this. You're probably frustrated. You look at your super statement and see a balance that's growing slower than a bad pot plant. You see a list of fees for services you don't feel like you get, and your investments are a total black box. You have zero control, zero say, and a nagging feeling you could be doing a whole lot better. That feeling is so completely valid. For most people, the industry standard super fund experience feels powerless. And then you hear about the stories of SMSF, or self-managed super fund. It's presented as the perfect fix. The promise, it's intoxicating. You are finally in the driver's seat. You get to pick your own investments: Aussie shares, international EFTs, residential or commercial property, and other artworks and investments. It sounds like the perfect antidote, but that's only half the story. The other half is the part that usually gets skipped over, is where the real danger is. The second you start an SMSF, you're not just a member, you become a trustee. This isn't just a fancy title, it's a legally binding role with huge responsibilities. Think of it less like upgrading your car and more like getting your pilot's license. You can't just get in and hope to figure it out on the way. Being a trustee means you are personally on the hook for everything. You are responsible for creating a compliant investment strategy, keeping perfect records for every transaction, organising an annual audit, and lodging an annual return with the ATO. On average, trustees can spend up to 100 hours a year managing their fund. That's over 2 full weeks' work. Do you have that time and the skills to spare? You're now the fund manager, and the power is all yours, but so is the responsibility. One of the stickiest myths about SMSFs is that they are automatically cheaper. While an SMSF can be more cost effective for many people, the costs can spiral and eat away at your hard-earned savings. Let's break that down, what it really costs. Well, you've got setup fees, which can run anywhere from a few hundred to over $2,000. Then there are the yearly costs, and these aren't optional. We're talking about accounting fees, mandatory audit fees, and the ATO's supervisory levy. The latest ATO data show the median operating cost for an SMSF is thousands of dollars a year. The general rule of thumb is you need a balance of at least $200,000 for an SMSF to start being cost effective, and $250,000 minimum if you want to buy a property inside of it. Below this, the fixed costs can eat a huge percentage of your balance, and that cheaper option ends up costing a fortune, where most people get into serious trouble. An SMSF is not your personal piggy bank. The ATO regulates these funds with an iron fist, and the rules are incredibly complex. The core rule is the sole purpose test. You can't get any personal benefit before you retire. For example, you can't use the fund's money to pay off your mortgage or lend your cash to yourself or your family. You, family, or friends can't live in the residential property your fund owns. The penalties for stuffing up, even by accident, are brutal. The ATO can fine trustees personally thousands of dollars per mistake, and you can't use the fund's money to pay for that fine. In the absolute worst case scenario, the fund can be declared non-complying. If that happens, nearly half of the fund's assets can be taxed at the highest marginal rate of 45%. One mistake could literally wipe out half of your life savings. The rules are always changing, which is why having the right team is so important. A great example is the proposed Division 296 tax, which affects super balances over $3 million. This rule introduces an extra tax on earnings, including unrealized capital gains. This creates a huge cash flow problem, especially for funds with a single lumpy asset like property. What's more, the 3 million threshold isn't indexed to inflation, which means over time, more Australians could get caught by it. The good news is that the average Aussie, less than 1%, won't be impacted by this anytime soon or at all, as the average assets per member is far below that threshold. But it's a perfect example of why you can't just set and forget an SMSF. These kinds of changes require constant attention and demonstrate why you need a team of experts who stay on top of the rules for you, like me, the SMSF Property Guy. So after all these warnings, how do you know if an SMSF is the right move for you? Well, it's not for everyone, but for the right people and help with the right experts, it can be a life changer and your most powerful tool to create wealth for retirement. I've put together 2 resources to help you figure it out: my SMSF blueprint and a super comparison chart. The blueprint gives you the foundational steps, while the comparison chart helps you see if your current super balance and goals align with a property in a self-managed super fund. If you want to explore this further and get guidance that's tailored to your situation, the best place to start is by visiting our website at the smsfpropertyguy.com.au. There you can book in for an SMSF investment property strategy call with myself. Check the description to download your free SMSF blueprint and comparison chart. We can help you navigate the SMSF complexity and figure out the right path for your retirement. Thanks for watching. So, what do you reckon? Isn't SMSF as good as it sounds? Let me know your thoughts in the comments below.